We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovic. Joining me today is Greg Weldon, publisher of WeldonLIVE, 39-year financial market veteran, and commodity trading advisor. How are you today, Greg?
I'm great, man. How are you doing?
Excellent. Great to have you back. And if I'm not mistaken, you're a couple of weeks away from celebrating 40 years, right?
Yeah, actually going into my 41st year next week, believe it or not. So yeah, we'll be knocking down number 40 in 5 days, something like that.
Incredible. That's
hard to believe, actually, but yeah.
Well, it's a great long career with which to have a lot of perspective. And, you know, I want to kind of start by getting a little bit of that perspective. You know, I read recently that you started writing The Gold Guru again after 3 years of not writing it. So if you could tell us a little bit about the history of that, you know, specific focus for you and how it came to be.
Sure. It's a good question. I mean, it kind of goes all the way back to, I started on the floor of the Commodities Exchange in the gold and silver pits in the World Trade Center in New York City. And I wrote the book, about trading gold in 2006 called Gold Trading Bootcamp. And the first chapter is called Trial by Fire. And this is what it was, because I was in telecommunications. I went to school at Colgate. I studied astronomy, and I didn't know what I was going to do. And I walked onto the floor. I went to take a friend of mine out for his birthday, and he worked in the gold pit. I had no clue. Never had seen anything like this. Trading Places hadn't even been released yet. I was working there when they filmed Trading Places, and they did a lottery to see what people that worked there would be the extras in the trading scenes. So a lot of my friends are in that movie. I didn't get picked, but and it's just like, it just blew me away. And I started like raw. I'm there and I'm talking to somebody. I'm 6'10", he played college basketball and did a stint in Europe. And I'm standing there and waiting for my guy to finish this write-up, because everything's on paper. There's paper all over the place. It's like you're walking through an ocean of paper just to get there. And this guy comes up to me, starts talking to me. He's 6'4". He was in his 70s, an older guy. And we had this nice conversation about basketball. And now my friend's ready to go. We started leaving. I said, dude, how do you get a job down here? This place is great, right? And he goes, you got to know somebody. I go, you've been here a couple of years. Don't you know anybody? And he goes, that guy you just talked to runs the largest firm on the floor. And it's like life-defining moment where I just planted my foot. I turned around. I went back and asked the guy for a job. And he hired me because of my size and my height, right? Never happened these days. And not only that, they stuck me right in the middle because I could hand paper over people's heads and see back into the booth and the signals that I didn't even know what they meant yet. And it's like trial by fire. The point of all this is that I started something called the Pit Bull, okay, kind of play on words. We're in the pits, Pit Bull, here's the bull that's happening. And so I've kind of been writing about gold and silver for 40 years too, to some degree. I had something called the Metal Monitor for a while, and that was when I left Goldman Sachs and went off on my own. I got hooked up with Kathy Jones at Prudential, one of the legendary research director, and the Metal Monitor became Prudential's official precious metals research for a number of years. So then back after 2008, I started thinking, gold, you got this secular bull market. I think you're going to see another run, which we did, of course, into 2011. So we started Gold Guru. But then gold came off, and then gold went into a funk. And as well as I do, the last 3 years, gold's gone nowhere. Basically flatlined with a lot of movement up and down, but essentially no net change, literally over a 3-year period. So I just started thinking, look, I think this market's ready to blow. It's like there's no involvement. The open interest is low. People have dumped the ETFs to some degree. So I think there's going to be chase the move as it breaks out. And so we started the Gold Guru again. The response has been phenomenal. It's a variety of things. We want to provide as much as we can for as many people as we can. Obviously, I can't know what everyone's goals are. I'm not a financial planner. I'm not going to do all of that for you. What I can do is say, okay, here's a portfolio for conservative investors. Here's a portfolio for more aggressive investors. Here's the futures portfolio for really aggressive investors. And we have a variety of ways we put those together, discretionary based on my experience. And then I wrote algorithms. I'm a math and science geek at heart when I was in my 20s, and that's our quantitative work. So we actually rank all the mining shares, and here's the best ones. And it's not necessarily performance. It has a lot to do with trend and the potential for the trend to strengthen too. So there's a lot that went into this.
Mhm.
So now we're offering that, and certainly would offer, any of your viewers or listeners a chance to, get last week's. And we do Wednesday is a gigantic weekly piece where, it's macro, it's monetary, because I want everything to mesh together. Technical, quant, psychological, macro, monetary, all of that. Supply, demand, and gold too. So we give it to you all. And it's, to my mind, the idea here is really, it's almost a mission statement for me, having done this so long, to want to help people, because you and I know, and everyone out there knows, increasingly more difficult to keep pace with the debasement in the purchasing power of your paper money, your wealth, your income, all of this. And you print this much money, of course you see what happens. I mean, look at the guy that plays for the Angels, Ohtani, right? The guy's going to get $100 million a year to play baseball. I mean, tell me there's not inflation in assets still. Tell me that the dollar doesn't buy you less. And the degree to which stuff like food, where you're getting smaller portions and paying more now, So I think this is a secular change. I've seen the entire 40-year downtrend in interest rates and inflation. All right. And it kept saying more money chasing fewer goods, the definition of inflation. We've been waiting for inflation like we're waiting for Godot. 2021, I started writing Waiting for Godot, the alternative ending, where Godot is inflation.
We spoke about that last time.
Yeah. So the idea here is to help people, and using the precious metals and being pretty specific, and then providing the information that people can then turn around and use themselves very effectively.
Mm-hmm. So Greg, let's get a bit more specific if we could. What's changing right now for you to, go back to writing the Gold Guru? And is it just that trend that's changing and the momentum coming back in as you see it?
It's really everything. I mean, it's the crystallization of kind of what we've been through the last 3 years, which is printing tons of money, getting the inflation. And, you got to go back to 2018. And if you've heard me say this before, I'm sorry if it's redundant, but it's so important. In 2018, Jerome Powell became the Fed chairman. Mm-hmm. He told us what he's going to do. And they wrote 310 pages, 11 different white papers. I read every single word of all these. And, he told us exactly what he was going to do. We're going to let inflation run. We're going to use an 8-year average. We want it to be above average and have the average go above, 2% and for a time. And we're not going to have what they call tolerance bands that some central banks use, which means if it gets to 5, we'll start scaling back or something. No tolerance bands, meaning we will tolerate any level of inflation. We don't care how high it gets. This is what they're saying. And then we will raise interest rates. We'll follow the Volcker playbook, because Powell is a Volcker disciple. He has told us this in many of his speeches before he became Fed chairman. So the problem is they waited too long to tighten, and now they'll probably wait too long on the back end. And what I really, to answer specifically the question, what really gets me excited and yet petrified at the same time is that, when you get this downturn that is absolutely coming in the economy, and we can talk about that in a second, why now as opposed to 6 months ago. But when they start printing money again, and they will, because, when they're looking into a debt deflation abyss, they will choose to reflate every single time at any cost. The next time around is going to be, you have to print exponentially more money to have the same impact. And things are so ridiculous now. I mean, Tom, in the last 4 months of the fiscal year, public borrowing, and it ended September, public borrowing, 4 months, $1.767 trillion. That's $5 trillion on an annualized rate. This spending's out of control. The case is before the Supreme Court now that will allow the government, if it's real constitutional, which I certainly think it won't be, that they can tax your assets now too. Mm-hmm. Pay. This is how we're going to solve the deficit. Take it from the rich people. Take it from the people who create the wealth, and we're going to tax that now too. So I think that you have reached the point of critical mass. You've reached the 40-year downtrend that's over. The Fed will be forced to acquiesce to higher rates of inflation. I mark my words, at some point in the future, not the next step, but 2 or 3 steps from now, they'll raise the inflation target to a band that will be higher. So these things are very bullish for gold. And I think relative to other commodities and other assets, gold is underperformed. And I think that that's about to change as well. It's kind of stuff versus paper, the old Jim Grant line,
Mm-hmm. So, obviously with Powell writing these, or let's say the Fed itself writing these white papers, at the time, 8 years ago, I believe you said, nobody was really or could have anticipated COVID happening. So, how do you think that ends up kind of factoring into that average or that that averaging over that time period?
Yeah, it's a really important question. I mean, I don't think it caused anything. I think it exacerbated and accelerated everything. So if you remember in 2019, you kind of go back to the fourth quarter of 2018, even when the German economy went negative on a real basis. All right. We started to roll over. The Fed was already easing. All right. You were headed towards a recession towards the end of 2019. You remember you had the stock market kind of cracked in the second half of 2018. You had the Christmas Eve low, and it was starting to fade. The economy was not responding. So I think what it did was it solidified the second part of the equation. If the equation is more money chasing fewer goods, you just changed the narrative on the fewer goods thing because you've had supply for years, right? I mean, the internet, one of the biggest things was price discovery, all right? And that made it uber competitive on everything. That's changed. And I think taking away from COVID, you ask yourself, well, what's the lasting impact? Well, the psychological impact to me is still lasting and still important, all right? People be less concerned about price, getting the cheapest price, and more concerned about making sure they can secure supply of something. So that's a psychological shift. Then you have more money printed. I mean, again, just public borrowing in 4 months is 1.7 trillion. I mean, just think about that, man. I mean, that's outrageous. And when that money, it's cursing around and you have less goods and you have the whole supply chains. I mean, let's not forget El Nino. I think we even maybe talked about this like months ago because I've been on the El Nino kick since March and started noticing the situation in Panama Canal, which is now regular news, right? So I think there's a lot of these things that have all kind of, it's again crystallized and kind of converged here. And you have a lot of science with what's going on the planet where it's more volatile. The frequencies of the crust of the planet are higher. And this leads to more natural disasters, more volcanic activity, tectonic shifts, all these things. And when you look at where gold is and how much money's been printed, and if you want to make the comparison to money supply with gold, and I'm not a gold standard guy by any stretch of imagination, it's ludicrous to even suggest that now. But if you want to say, where's gold going to go? Well, who knows? But what's a fair value for gold? It is much, much higher than we are now. And that dynamic leads me as a trader to say the risk reward is fairly one-sided. Short term, that's never true. But I think over the long term, that is very true right now with gold.
Mm-hmm. So, Greg, maybe if we could walk through a little bit more, let's say the example of the Panama Canal. Mm-hmm. For those that don't understand those dynamics, explain that a little bit more. And is that, another piece that's just adding to this further inflationary cycle that we're very likely going to see here?
Yes, it is. And it's El Nino, which of course is a weather event in the Pacific Ocean. And I mean, the numbers from the El Nino when it started were mind blowing. And not only that, we went from La Nina to El Nino shifting, which really, I don't remember ever hearing, seeing, or reading about. And I did some research on this, couldn't find any other occasions where it happened, where it's like this. Usually there's a lag with nothing in between these types of weather events. But what happens is the ocean warms up. Of course, you probably know most of this, but the radiation levels in the ocean between 100 and 150 meters below the surface were mind-blowingly strong. So you see this El Nino in the context of what's happening on this planet where everything is polarized and everything is more volatile. You have to say this could be one of the worst El Ninos ever. And that we're already saying that based on the early readings comparing to other El Nino events in the beginning. And what this does is affects food mostly. You get drought in certain places, you get heavy rain in certain places. Again, it's not just global warming, it's record cold too. I mean, look what's going on in Russia right now. Record snow, record cold, it's minus like 100 degrees in Siberia. So it's polarization. And when you get this, it affects weather in different ways all over the world that affects crops in a big way. This is why cocoa just made a new high. All right, Ghana's affected by this. And they're a primary producer of cocoa. I mean, you can see a lot of things. Sugar, for example, in South America. So when you talk about inflation, you got to kind of separate energy from everything else. And that includes food now. It used to be food and energy and not so much anymore because food is its own dynamic. There's 119 food items in the CPI in the US. And I keep track of them. And I'm telling you, there's still 25% of them are still double digits. All right. It's not like energy where you got crude, natural gas, and gasoline. That's it. So you can watch the base effect. You know kind of what the energy impact's going to be. You don't have that with food. Mm-hmm. So you look at energy, it's kind of negative. It could have been a positive base effect, but the recent declines in price have kind of flipped that to somewhat negative base effect. But when you look at something like food that is going to be embedded, you look at something like shelter, which is your biggest cost for a consumer in his monthly budget, is shelter. And that's not like it changes month to month. All right. You have big jumps that are sticking for the whole year and come again. People, landlords don't charge rent based on how much they think the tenant can pay. They charge rent based on the price of the property. And wait till the Fed eases again and mortgage rates come down. You're going to see home prices go crazy to the upside because there's not enough supply. It's that simple. So, yeah, I think there's a lot of these things that all kind of come together. I hate to use cliches, but it kind of is the perfect storm. But it's bigger than that because it has such macro implications, even to the degree of what's happening on the planet scientifically.
So, I want to go back to kind of how the Fed is seeing the inflation right now and what Jay Powell's words have been in response to that. Do you think the Fed sees themselves as being restrictive enough to this point?
That's a really deep question. That's the question right now. And there's a lot of different ways you could take it. I think the Fed, let's first talk about where the markets have already taken the Fed down the road next year and the year after, right? You're talking about the 2025 Fed funds. I mean, you're talking about like 4%. I mean, this is kind of, the Fed doesn't want to see that. The Fed wants to be restrictive for longer. They want to ensure that inflation is coming down. The best way to ensure that is kill demand by having a recession. So we're still not there, right? The Fed's probably not, I don't think the Fed's going to raise again. But what if inflation goes to 5? What if energy spikes and something in the Middle East pops off? Do we think really the Middle East is going to end peacefully? They're going to no, I don't see it. I see the probabilities of that being very small, let alone China's now saying, hey, you're crossing into our territorial waters, U.S. in South China Sea, playing their land games with their man-made islands like they did with the Philippines. You have Putin traveling to Saudi Arabia, all right, Shiites and Shia getting together. You think this is just going to go away? No. So when energy spikes back up, what if inflation goes to 5? The Fed's 5.5. That's not restrictive anymore because it's based on the real policy rate. R star, part of the 310 pages of white paper, at least 3 of those white papers were dedicated to R star, which is to define what is neutral. So once you know where neutral is, then you can start to say what is restrictive. Then you can start to say how restrictive do we want to be. The question becomes, if inflation rises, they're not restrictive. And that's where the whole thought process that I think we talked about well before Jamie Dimon even did, that you might have to go to 7 to remain simply restrictive, all right, because inflation has risen. But what if inflation goes to 3? Now they're too restrictive. And that's where the rate cut idea comes in. So we'll see. I mean, I think that inflation comes down and goes back up. And I think that when the economy hits the skids, this is where it is for gold. This is a sweet spot for gold where the Fed is forced to, by the economy, to acquiesce to higher levels of inflation, generally speaking.
So as we're really looking at, let's say, central bank policy right now, are there big differences between the US and, let's say, this expectation a year out for what rates are going to be and the rest of the world?
Yeah, big time. And that's another huge issue right now. And that involves the dollar, which is a risk to gold. Okay. So let's just first say, let me just add to what we just talked about, because I also kind of said after this, we went to the risk on, we got long Bitcoin and gold and treasuries and maybe 2 weeks ago. And one of the things I said is, look, you're going to have fits and starts because as you drive yields lower, the Fed has to remain at least looking like they're vigilant. So the rhetoric will remain very hawkish. And we just saw that on Friday, right? So that's number one. Number two, yeah, I mean, look what's going on in Europe. I mean, Italian inflation went from 11.6 to 0.8 in 10 months. All right. They are now have a policy rate that is very restrictive in Italy into a financial fiscal situation that's kind of a mess, so on and so forth. So we're long Italian bonds now because I think that's a great play. But yeah, so that's all of a sudden now the dollar has been coming off against the euro because U.S. rates were coming down and the rate differentials were narrowing. Now they're expanding again because now European rates are falling even faster than U.S. rates are. And that bid the dollar up, and that's one of the risks to gold. I think in the same vein, though, bigger picture, it's always still on the dollar. It's still always the key. They're going to play the dollar card at some point in time. You're not going to want to wait for that to happen to be long gold. On the other side of that process would be what's happening in other central banks, particularly in emerging markets. Take Brazil, for example. They had really high inflation. They took rates to 11.75 or 11.25, I forget which. Inflation comes all the way back down to 5. Now they're really restricted. They cut rates 3 times already. And actually, in the case of that, their exports start to rise. The market starts to rise there. And all of a sudden, it's a case where the currency is strengthening because it's a place that's been underinvested, that's going to get investment in this risk-on environment, which I think some emerging markets look very attractive here relative to the U.S. stock market. So, yeah, that's a big question, and that plays into the dollar, and that plays back at the Fed. And I think that one of the reasons that this kind of narrative has shifted a little bit towards the dovish side already is because the dollar had been so high. I mean, emerging markets were getting crushed. Look at some of the currencies that are not kind of considered primary emerging markets, where the currencies have been filleted this year. Nigeria and Angola are 2 great examples. Why do I point them out? They produce oil. They're OPEC, former OPEC members, pseudo-OPEC members. Those 2 countries alone are so below their capacity and production that if they reach their output that they had, before COVID, they would take up all the slack right now in terms of the shortage of day-to-day crude oil demand. It's still, a deficit right now until the fourth quarter. So, there's a lot going on when you start to talk about the global situation. And that's why I love, getting up at 1 o'clock in the morning every morning and do this for 12 hours, 16, 18 hours a day, because there's so much to look at and there's so much you need to know.
Well, you must be really passionate about it to get up at 1 in the morning to start your day at that point.
Yeah, well, I mean, we do a lot in Europe, and we got a lot going on. And if I can get, I've kind of trained my body where I don't know if you ever heard this before. I'm getting a little crazy on you, but you really, a lot of your sleep cycle is wasted space. I mean, the cycles within your sleep that are healthy, and the REM and all these things, the healing cycles, that's about roughly maybe 60% of the time you sleep in an 8-hour day. So you have electronic ways to kind of train your brain to eliminate those cycles of sleep. So you get the healthy sleep in 5.5 hours. I get 5.5 hours. I'm quite spry in 1 o'clock in the morning, let me tell you.
Well, that's you're an efficiency master then, it sounds like.
Definitely.
So, Greg, it seems like there's really 2 opposing factors that the Fed has to look at here. They're being very data dependent, obviously, and they've said that point several times. So, on one hand, they're having to fight inflation. On the other hand, the mandate is for price and market stability, right? So how is the US economic data continuing to support this idea of staying higher for longer?
It's not. I mean, it's already rolling over. And this is another really great point of conversation because, people are kind of like, in the third quarter, you got the big GDP number and the economy is so resilient. And, oh my God, the U.S. is fine because all this tightening really doesn't matter. And, we're concerned about the lag time and everything. It's not even about the lag time. It's about the simple fact that they were so far behind the curve. By the time they started raising rates, inflation was so high, you had a minus 575 real rate. It's one of the most stimulative policy stances we've ever had, right? When they're saying we want to get tighter, we're going to raise rates and everything. So the lag time was coming from a stimulative standpoint that has now flipped to a restrictive standpoint. And you're hitting, because it's around May that you hit the point where the real policy rate got above inflation. Inflation's coming down. And all of a sudden you are restrictive where you weren't before. So we've only really been restrictive for like 6 months. And all of a sudden now you start to see the economy roll over. Here's your lag time. You're right in the zone. I mean, the service sector data has been atrocious. Any of the surveys, horrible. I mean, the data is just awful. I mean, even retail sales, if you take the dollar amounts, because it's not adjusted for price, I mean, most everything is still down year over year. It's mind-blowing. You have a lot of disinflation to deflation in the economy, let alone the rise in delinquency rates, especially on credit cards. It's one of the largest, it's the second largest increase in a 12-month basis in the delinquency rates on credit cards we've ever seen, second only to 2008. Now, it's not high nominally, but the increase is the highest ever. With all the forbearance and all the credit that's been taken out, I mean, it's a kind of a landmine. It's waiting to be stepped on.
Well, that was a piece that I wanted to go back to, is this idea of this day of reckoning in a way for the economy and for the market. So really it's because of the way you see it, because of that lag time and the actual point at which monetary policy actually started being restricted.
Yeah, absolutely. Because the lag time's now. So you're hitting the time when they finally got restrictive. It takes time to flow through. But I mean, that doesn't mean there's not opportunities either, because to me, you look at the housing numbers. I mean, they're really interesting to me. You have these high mortgage rates. Okay, you've priced out first-time buyers. Its affordability is terrible. Prices are high. The cost of borrowing is high. But at the same time, you need to build more homes. So I think the home builders have been really hot. I mean, you start to look at some of the sectors of the stock market that have been hot and probably remain hot. I think the home builders are a great one. Anything kind of linked to that sector. So, always trying to look for the opportunities as well within the context of what you see the downturn. What's going to be first to lead us out? So you look at like the XLRE, which is the S&P retail ETF, index ETF. I mean, it's been crushed and it's come down and it's made a nice little bottom. So we're looking for places where it's going to be the next phase. Yes, the economy's come down. We kind of played that already. And I think a lot of markets are looking through that, certainly predicated upon getting to a 4% Fed funds rate by the end of next year, if not early 2025. Mm-hmm. Now, if all this, the caveat and the opposite argument to this is, if the stock market is where it is because we're pricing in that much easing, what if we don't get it? Then what? Then the stock market's in trouble. Mm-hmm. I mean, this is what it takes to keep the market like floating. I don't think that's really great performance, let alone the fact that the market breadth is still really kind of crappy here. I mean, it's still a very
that might be an understatement.
Led market. No, I mean, that's a technical phrase that we use often around here. I mean, it's just, I'll tell you where you see the breadth. The breadth is in the mining shares. I mean, there is a lot of mining shares that are all of a sudden trending bullishly. I know, because I look at the list every day and it's gotten longer pretty much every single day for the last 2 weeks. And today was the longest it was. And you talk about yesterday's move. I mean, we can talk about that now too if you want, but I think you're going to see a lot more of that as well.
So, Greg, exactly as you said, we're talking here on Tuesday, December 5th. Of course, over the weekend, gold on the Asian Open shot up to, over $2,100. And I would say that was emphatically rejected. Some might argue that we were overbought, overheated, whatever explanation you wanted to offer for that. But let's talk about yesterday's moves and how you see that.
Yeah, I mean, I mapped it out pretty, almost by the minute, just looking at the volume and where the buying. So essentially what you had was, you gapped it up, you ran it up, but it's because, again, people are not that involved. And you hear that a U.S. warship got attacked by drones out of Yemen, and all of a sudden you got people plowing in because they're not involved. And so you had this huge buying rush and it just ran out of steam. And you know how gold is. People are up there. They're going to be, advantageous and strategic about this. So I think, you had sellers that came in that saw the market got exhausted and hit it hard. And what you did was you caused those same people to liquidate. It's amazing because the on-balance volume, the open interest, you look at all the metrics of the activity. It went way up on big volume and it came way down on big volume. And where the open interest went up and came back down. And where it is when it went up, it's breaking out of a long downtrend too. So is this a bloated market? And that's why they kind of popped off only on a short-term basis. I really believe that you are in the range now of making the lows. You might dip back below 2,000, but I don't see you staying there for very long. And if you get there, unless the stock market's really coming off hard, if you get below 2,000, it's a back the truck up moment. You've had 3 of these moves to 2,000. They all got shut down very quickly with weekly outside downside reversal patterns. You almost had that here, all right? But you had it last week too. So we never seen it 2 in a row. And now you're staying above 2,000 where you were immediately below 2,000 before. You know how it is. They can intervene if they want. Maybe someone's stepping on this, because the last thing the Fed wants to see is the stock market goes to new highs, gold screaming through 2,000, and they're supposed to be inflation vigilant here. So I think there's a lot of different things going on. But I think the end game for me is two things. Number one, if this market is going higher, and if this market is going higher, you can't stop it. You've held it down, and it's like the beach ball underwater. Once you let go, it flies, right? And number two, again, early 80s started this. Gold and silver were crazy back then. I remember the day that, I forget which bank it was in Chicago, failed. And you had moves that you had seen, since the 70s, right? And we had days where silver would open limit down, trade to limit up, and close limit down. So I think these kinds of moves where you were actually up like $60 and the peak to trough decline over that period, including this morning, was almost $100. So I think you're going to see a lot more of this. So if you don't have the stomach for this, then maybe this isn't the place to be. So this, it really makes people get a grip and fully understand what their goal is and how they're going to approach this market and how they're going to trade it or invest in it or deal with it. Because if you want to be a trader, then you better be ready for days like yesterday for sure, because you're going to see more of them. And I think this does lead to the you're in the zone now where this is the next leg of a secular bull market that began. You can trace it all the way back to 71, you trace it back to 1999, or you can trace it back to the fourth quarter of 2015. All of the counts work. All of them show us going higher in a big way from here. So you got the technicals working, you got the monetary fundamentals working. So this is one of the times where and this is why we started the Gold Guru again, because it's kind of a long-term buy and hold if you're an investor.
So what does that volatility mean right now? That is kind of that wrestling back and forth around that $2,000 level.
Yeah, I mean, I think it's, again, I think it's officialdom doesn't want this thing to pop off, because that could be one of the worst signs to the market that, central banks are not being inflation vigilant, or they're printing too much money. It may hamper them in the future in terms of the political will or the stomach to print as much money as they're going to need to print. So I think and the time that we're in, where things are so polarized. I mean, what you had was this huge buying and this huge dumping. That's as polarized as you can get. So I think it bodes well for the longer term price direction, and it provides opportunity for people that can be nimble and be in and out. I'm not a scalper. I'm not a trader. I want to hold position for months, but at the same time, I'm happy to take a 2-week profit if that's what the market's going to give me. So, and that's kind of why, the research, I don't trade the equities myself, but the quant work is a beautiful thing, man. And we've licensed this out to institutions too in the past. And so, I mean, if you want to know which stocks I think are going to perform the best, and, you want to hold either a small, very select group, or you want to hold a broad base group, we got both of those portfolio in the Gold Guru. I think that's kind of the way that most people are going to benefit from this, because I think you will go into a period where the mining shares have been depressed, the mining shares have underperformed. And if this is a true bull market, what should happen? The mining shares should outperform. And I think that they definitely, in my mind, over the next 3 to 5 years, outperform the stock market as a whole, for sure.
But before we get to the miners, Greg, I'd like to talk a little bit about, let's say, the gold adjusted value of the dollar chart. Yeah. How do you use that, and what is that telling us as well?
It just kind of gives you a sense for the path of least resistance, or kind of what's going on. I mean, when you use these kinds of charts that take something and then compare it to itself versus something else, you say, okay, well, gold is up here and gold versus the stock market's down here. So what does that mean? The stock market should get crushed, or it means gold, it could be both. So it's not a definitive thing that you're going to make investment decisions based on, but it's just another tell. I'm an old school high stakes poker player, and I'm not a gambler. I don't believe in gambling. I want to play where I can have the odds 85% in my favor, and that's where I put my money in, right? Same thing with trading. So, when you come to the extent of, getting involved in these markets, I think it really behooves you to try and make the optimum decision every time, and to be aggressive when you're doing it. And I think that's, again, it's just going to be more difficult going forward to keep pace. A great example is Argentina. I mean, we just saw a new election. They're going to try and dollarize the economy and everything. But until then, the Merval makes a new high every year. It's one of the most bullish stock markets on the planet. The thing is always skyrocketing, right? So why isn't everyone in Argentina rich? Because it still lags the debasement in the currency and the rate of inflation. So you can't just say the stock market's going to be the thing. To me, this whole cycle of 40 years means one thing, and one thing in particular, and that is that, buy and hold and passive investing in the stock market is going to be a trailing venture, and it's not going to keep pace. So you got to be nimble, do other things. And that includes currencies, bond markets, like we talked about with Italy. I mean, Italian bonds, a great opportunity here too. I'm a future market guy, but nowadays you can use ETFs and still kind of recreate a hedge fund / CTA portfolio, because I think that's what people are going to have to do. It's not passive indexed or buy and hold stocks. It's become your own hedge fund. That's the best way to keep pace. So
what do these moves mean for the GDX as well, Greg. Like, are there important levels that you're watching in the GDX right now?
Yeah, you're pretty much just below them. So, the SIL too, it's very well set up, but it has been set up a couple times this year and it's been disappointing. So we'll see what happens. But I think the dynamic here is much different in terms of the timing, the timeline, in terms of how that affects the Fed. So I would say really just above the highs we had last week. I mean, to whatever degree, I haven't seen where we closed or in the last hour or so, but yeah, I think that it will also, if you look at it too, the juniors starting to break out against the GDX, which is a positive sign, and the mining shares starting to at least kind of bottom and looking like they might push to break out against the price of gold. You look at the gold silver ratio, it still kind of is nowhereville, and it still suggests, gold. So the question becomes, is this a gold centric move, or does it explode into a bigger precious metals move? And the jury's still out on that, to be honest with you. I think it is a broader move because you see the kind of dynamic, generally speaking, with risk on emerging markets and so on and so forth. But that does require the dollar to be lower. And that's a little bit of what worries me, because Powell is not going to want to play ball this quickly. Powell is not going to want to basically validate the pricing in the forward Fed funds futures. It just isn't. So that worries me from the context of bidding the dollar up, which then gives you a reason to dump gold. The reason that I'm not too worried about that is because the market's not hugely long gold. So it's not like we're sitting here thinking, oh, you're going to see this huge liquidation move to the downside and it's going to puke itself. I don't see that happening. So I think it's going to require some patience. And I think that you may still have these fits and starts that are a little bit less dramatic than they have been over the last year. But I think longer term, the mining shares are going to perform very well because you have money in the stock market. And if the rest of the market is performing, that money could move. And this could be a thing where I remember when I used to, be the research for Pru, and I would go down to the bullion desk, and John Fallon, legendary gold trader, went to Colgate, which is where I went to school. And we would sit around and talk about this kind of thing. Like if you get a move of just, you get a thing here where the average global wealth manager or RIA or, FA decides, put 5% in gold. You probably heard this before a million times, right? The market's not deep enough, man. Some of these stocks are not deep enough. These things could just explode, and it wouldn't take a huge amount of volume or liquidity to come into the market to make that happen. So I think that that's a huge plus as well. And I do believe that as we go forward, this will be a thing that will become more mainstream in terms of, we're not keeping pace in the normal ways with passive investing. We need to do more things. And that first thing for a lot of people will be gold.
Mm-hmm. So Greg, you're talking about the miners that don't have a lot of, let's say, volume or ability to just absorb a lot of volume. I think that's a better way to put it. That's something that I think part of our listeners on this show are very focused on, is the junior miners. So you have a bunch of rankings of junior miners. What do you base those rankings on, and what are you looking for?
Bank is quantitative, purely quantitative, using my algorithms, and then in terms of the recommendations that are discretionary, I will then take all that and then put it in the context of what's the chart look like? What does the company look like? Maybe a little bit. So you kind of get both sides of it. Here's the quantitative that is telling you which one has the strongest bullish trend right here and which one has the background that would lead normally statistically to suggest that it has a lot of upside potential. And I would throw another thought process in this mix. And one of the reasons that we include them and use them is because, as opposed to buying like a call option on gold, where you're paying away premium, you have time decay, and you have an expiration date. You buy some of these stocks at $1.50. I mean, rather put in $1.50 a premium in a junior mining share than a call option. You have no time decay, you have no expiration date, you have no time constraints whatsoever, and you're willing to lose the whole $1.50 because a lot of these stocks are pretty much worthless too. I mean, let's be real. And the other thing I would point out too, that as this goes, one of the things you may see happening, which I think has kind of already happened in a kind of roundabout way, is that the miners that don't even really mine the gold that sit on these properties, this becomes more attractive for a big cap behemoth that could come in there, snap it up, on the cheap, relatively speaking, and actually go in there and mine the gold and get their own returns. So I think that that's one of the reasons you've seen kind of a bifurcated market where, Newmont and the Barrick and some of the big names have been underperformers, have been down close to their lows. I don't know if it's a debt issue because you're taking on debt to make acquisitions. I think that will pay off huge for them. And I think it will pay off huge for the smaller miners. And that's why we like the whole sector, because you have so many different ways to play it and so many different influences, most of which, not all of which, tend to be positive. I never want to be too one-sided. I've been in this business long enough to know the second you think you know something or the second you think you have the market beat, you get your ass handed to you. I mean, real quickly. So try and keep it humble. Try and keep it a new perspective every single day.
Mm-hmm. Excellent, Greg. Well, I appreciate you coming on and sharing your thoughts with us on these topics. Is there anything else maybe on your mind that you want to share before we wrap up?
I would just say the whole commodities complex, and especially the foods. I mean, you got a lot of ETFs that you can, replicate some of the food commodities, and I think they're very much underused. And I think that's another way the individual investor out there can, try and keep pace. I would also, of course, offer any of your viewers or listeners a free copy of our Gold Guru, and then just email me at sales@WeldonOnline, WELDON online, one word, Weldon Online, sales@WeldonOnline.com, and I'll send you last week so you can see what we said last Monday. It's usually Wednesday, but we did last week. We had to do Monday. And then we'll send you the fresh one, which will come out tomorrow. And then, you can choose to subscribe or choose to take that information that's very valuable into itself and do whatever you want with it.
Excellent. And of course, you're available on Twitter as well at WeldonLIVE and also at money_podcast as well, right?
That's correct. We got the New Age Investing, Money Markets and New Age Investing podcast, which you can find. It is, yes, thank you, at money_podcast. We also are doing the New Age Investing Portfolio Playbook, which is all the same stuff as the Gold Guru, only applied to the S&P 500 and the sectors. And we rank every stock in every sector, quant portfolios. We also have the discretionary portfolios, which would be something like recently we were long the Euro FXE, the ETF there. We're long the sugar ETF. We're long the agricultural ETF. We're long uranium, by the way. Big, you want to talk bull market, uranium, supply demand, very much imbalanced. The URA and some of these stocks have been extremely hot. We caught this move really well. So that's also in the Gold Guru. It's not just gold. It's all the precious metals. It's PGMs. It's uranium. It's the base metals, copper, aluminum, nickel. So you're trying to cover kind of all that area of asset class that would be metals per se. So we also have the portfolio playbook. You can get copies of any of this stuff by emailing me at sales@WeldonOnline. Of course, the podcast is public. Excellent. The other one thing I might mention, since we're doing the salesman thing here today, is YouTube. So it's user Gregory Weldon, and we post a lot of quick vignettes and stuff that are pretty informative that people seem to really like and find value in.
Mm-hmm. Absolutely, they're just bite-sized pieces just to kind of bring you up to speed.
Yeah, exactly. Quick is because who has time? The attention span these days. Twitter has almost single-handedly ruined this business, man. Everyone's an expert, and the people have attention spans of all of 5 seconds. So what are you gonna do? But if you really want to know what's going on, you got to do your homework. And I know, and people that are successful, they do that. They read. So
absolutely, and that's why we try to keep this long form, let's say, style alive by having these nuanced discussions and being able to get into the depths of all of these subjects.
Yeah, you do a great job. So kudos to you, man. That's why I'm happy to contribute anytime.
Thanks, Greg. Appreciate that. Yep. And thanks for your time today.
Yep, my pleasure, man.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.